Good morning and welcome to the Killik podcast for the Friday the 19th of December, the last of the year. This week's been all about developed market stability against emerging market instability and uncertainty. The stability came from the FOMC meeting on Wednesday when Janet Yellen reiterated the guidance on the growth rate in the US economy and the inflation outlook. She was also very dovish compared to market expectations in terms of the guidance of when interest rates are going to go up. So we were aware that considerable time was going to be removed from the statement, and we were looking for the new words, and the new word was patient. So they're going to remain patient and beginning to normalise. So that was seen as a good sign for equity markets. So we saw a big bounce in the equity markets, in particularly the S&P, so 4% up from the intra-week low. But we continue to see ongoing extreme volatility in the commodity markets. So Brent moved 5% intraday to the up and to the downside during the week. That's giving increased pressure on economies that are reliant on oil exports, and none less so than the Russian economy. So here you've got the Rouble, which fell 40% against the dollar intra-week until the Central Bank of Moscow came in and they raised rates from 10.5% to 17% and started buying rubles in the market using their foreign currency reserves. So as a result, we're seeing overall the emerging market currencies are weakening. In December, you saw a real acceleration of that trend, which is feeding through to far better performance in developed markets against emerging markets. And that's something we've been talking about all year. This is a 6-month chart. As you can see, there's a considerable performance gap there. So what happened the last time the ruble had this sort of wobble? So we go back to 1998, the LTCM crisis. And you saw the US economy, the Fed, cut rates 3 times, despite the fact that their economy was starting to grow. This had a tremendous effect on the S&P 500, and the PE of the market appreciated 45%, from 22 times earnings to 30 times earnings. What the market is starting to think about is a similar sort of scenario playing out in markets today. And we've already seen this week, following that fairly dovish guidance on Wednesday, an 11% appreciation in the S&P 500 PE from 16.5 to 18, as you can see there. So the key message from this week is central banks remain supportive in terms of very dovish monetary policy, despite the fact that growth rates are starting to pick up. In that sort of scenario, you tend to see markets expand their PE ratings and go higher. The potential headwinds for 2015 are the emerging market growth rates start to slow the developed market growth rates. That's perfectly likely and perfectly possible. And we'll continue to watch the ISM numbers and the jobs reports for signs of that coming through. You've also got dollar strength as a result of this movement back into the dollar away from emerging market currencies. And that starts to impact the earnings of US exporters. So we need to look at that fairly carefully. However, the empirical evidence suggests that a stronger dollar doesn't necessarily hold back the overall equity market, because investors start to buy into stronger growth within that economy. So the likelihood is that the Fed will remain patient going into next year in terms of interest rate rises, and the market will start to think about the possibility of a material PE re-rating even from where we are at the moment. In terms of the week ahead, we've got very light, as you'd expect, in terms of the diary. We've got some existing home sales on Monday. You've got some confidence numbers on Tuesday. You've got some Japanese industrial production numbers on Thursday. And the only company reporting is Walgreen, and that's coming in on Tuesday. So it just leaves me to say Merry Christmas and Happy New Year.